All right, guys. So welcome to the Forex Beginners Workshop. This is an event. It's a 4-day masterclass powered by 10 Trade. In 4 days, we'll be going through the rudiments, the basics of Forex trading, up to a point whereby you're able to have a better understanding or perspective of the foreign exchange market. All right. The good book says, if the foundation be destroyed, what can the righteous do? All right. So regardless of your pedigree as a Forex trader, if you don't have the right foundations, every other thing that you're trying to do would not stand. So I want to recommend that everybody that is here, you take this 4-day boot camp very, very seriously. Do your possible best to be available at each of the sessions. It's just going to be from today through to Thursday. All right. So ensure that you show up 6 p.m. every single day, Mondays through Thursday. All right. So in these 4 days, we'll immerse ourselves into the good. So my name is Tobi Okunuga. I'll be your facilitator for these 4 days. Please, I'd like you to feel very, very free in this class. When you have any questions, feel free to ask your questions in the chat box. I would also provide an opportunity for everybody to ask questions via audio verbally. If you choose to ask a question verbally, I like this boot camp to be very, very interactive and engaging as much as possible. Also, I'm going to ensure that I do not rush any topic whatsoever. I'm going to take my time. So you might realize that there are some things that I'm dragging, right? I'm dragging them purposefully so that you understand it, okay? So I wouldn't make any assumptions that you know how to trade beforehand. I'm going to teach as if everybody here is just getting started, all right? So let's start from the very basics of Forex. So what is Forex? Now, the first thing I want to come to your mind when you think about Forex is the abbreviation Forex, all right? So Forex is an abbreviation of foreign exchange. So Forex is foreign exchange in a nutshell, right? And it is the largest financial market that averages over volume daily, right? So what it means is that the average transaction that goes on in the foreign exchange market on a daily basis is 6 trillion US dollars. So that means it can be more than that in a particular day, and then it can be less than that in a day where there's little trading volume. But when it comes to buying and selling of foreign exchange, buying and selling of currencies, right, it is averaging $6 trillion. Today is Monday, right, February the 13th. Today, the transaction that occurred today in the forex market should also average 6 trillion US dollars. So we are dealing with a large market. The opportunities available to us is very, very huge. So think to yourself, from that $6 trillion market that you are trading in, what amount from that $6 trillion is going to come to you? You know, one thing about the forex market is that when there is no competition when it comes to forex trading, all right? So how much money you make will depend on how well you understand the market, will depend on your skill set, your trading skill set, all right? And that is what you are here to learn, how to leverage on the forex market to make money, right? So you understand that the forex market is open 24 hours a day, 5 days a week. So that means during the weekends, the forex market is closed. So we do not trade currencies during the weekends. So we only trade Mondays through Fridays. All right. So later on, we'll talk about the trading sessions that will help you put this into perspective. All right. Now, there is no physical location. Trading is conducted through electronic communication networks in various markets across the globe. So someone asked me one time that since we say it is a Forex market, an average Nigerian or an average African, when they hear markets, we know that a market should have a location, right? For example, the market in the Forex, when we say Forex market, we are not referring to a physical location, right? Everything is done online. So there is no office for Forex, right? Trading is done online. What we are doing is online trading, and it's conducted via what we call electronic communication networks in various markets across the globe, right? So bringing into perspective the online trading, what makes it possible for you and I to trade in the financial markets without actually holding physical cash, without actually holding physical currencies, right? So is made possible by what we call contract for difference. So let's read it. This type of financial instrument allows you to benefit from the fluctuations in the price of stocks, commodities, indices, and more without really purchasing them. All right. How do you make money in the financial markets? You make money based off of volatility. All right. So based off of how high or low price is moving. For example, how do you make money if you are trading the naira against the dollar? Okay, or vice versa. So let's say 2015, when $1 was, if you had bought dollar when naira was 300 naira, right? Now the naira in black markets to $1 is, so $1 is now 750. All right. So if you had bought way then, right, you would have made a whole lot of profit now because you bought dollar when the price is low. Now the value of dollar is very, very high. Okay, so that markup is your profit. All right. So, but rather than you as a Forex trader now, rather than having to buy currencies physically, right? We don't need to buy currencies physically, right? Everything that we do in the financial market as a Forex trader is done online, all right? So you are able to buy currencies online without having to physically touch or own those currencies. That is made possible by what we call contracts for difference, CFD. I'll take it again. This type of financial instrument allows you to benefit from the fluctuations in the price of stocks, commodities, indices, and more without really purchasing them. It's very, very good that you have an understanding of how you make money in the financial market, all right? So a lot of forex traders that are trading today don't even know what made it possible for them to trade like that. But, it's very good you have this understanding. So regardless of the direction in which the market is of a currency or a commodity is moving up or it is going down, you can make money in both markets. All right. So when price is going, so when, for example, let me use an example that we cannot relate to. So when Bitcoin was going up, when the price was increasing, you can make money with CFD. Also, as Bitcoin is going down now, as it has dropped now, when you're trading CFDs, you can also make money. So regardless of the direction of the market, regardless of what a currency pair is doing, either it is in a bullish environment, I mean, it's going up, or it is bearish, or it's going down, you can make money both ways as a retail trader. Contract for difference. So it's amazing what this has done for us as retail traders. So let us compare the financial market. We have different financial markets. We have the Forex market, we have the stock market, and now we have the cryptocurrency market as well. So let's compare the Forex market and the stock market real quick. Now, in the Forex market, what do we trade in the Forex market? We trade currencies in the Forex market. While in the stock market, we trade company stocks. So stock market is where you have, companies like Tesla, like Facebook, like, Google, companies like Apple. Okay. So if you are trading in the stock market, you'll be buying company stocks. So how do you make money in the stock market? You buy the company stock when the price is low, and then you wait for the price to, go higher to increase, and then you make a profit on that particular markup. In the Forex market, what is traded are currencies like the US dollar, like the Nigerian naira, like the like the Britain pound sterling, like the Canadian dollars. Okay, so in the Forex market, we are dealing with currencies. Meanwhile, in the stock market, we are dealing with company stocks. And the beautiful thing is that at 10 Trades, which is also the sponsor of this bootcamp, you can be active in both markets, either in the Forex market or the stock market or even the crypto market with 10 Trade, because of this phenomenon here called contract for difference here. All right, so you can actually buy Facebook stocks, you can buy Apple stocks with 10 Trade. Okay, so by tomorrow, when we start talking a lot about practicals, I would show you the 10 Trade platform and everything available for you to trade in the financial markets. Okay, so let's talk about the market participants. Remember that we made mention of the fact that the Forex market is averaging $6 trillion on a daily basis. Then you must ask yourself, where is that money coming from? Who are the people responsible for pumping that kind of money into the market on a daily basis? So the answer to that question is talking about the market participants or the market players. Who are the people playing, or who are the people involved in the Forex market? What is the makeup of the Forex market? All right, so we have hedge funds. So hedge funds are financial institutions that handle money for high net worth individuals and then trade that money in the financial market in the hopes of making a profit. So when they make a profit, they give, so based on the profit sharing plan, they give the investors money, their profits. So an average hedge fund has over $1 billion under management, right? Most have tens of billions of dollars or even trillions in their portfolio. And then we have several hedge funds that are actively competing to make money in the foreign exchange market, right? We have central banks. Every country has some form of a central bank, okay, that controls the currency in that country. For example, the Nigerian Central Bank, right? They are also active in the financial market. Why does central bank have to be active? Because they need to be able to compete against other currencies, do some trade deals in order to strengthen the currency of their country. So they have the power to move the market at certain times and influence the direction of a particular currency, how a currency would do. And also based on the policies that central banks will implement in their country, it will affect how well a currency is doing. All right. So commercial banks as well. These are banks like your Wells Fargo, banks like your Chase Bank, Bank of America, HSBC, all right? So those banks also actively trade in the financial market, all right? I hope you know that banks don't keep your money in the banks, so to say, right? So banks have to invest your money. So they invest in a plethora of, markets, okay, in order to make a profit. All right. So the banks would invest at least 90% of money that people deposit into different aspects. Okay. They also invest in, real estate. They invest in the financial market as well to make a profit. Right. So number four, we have Forex brokers. All right. Forex brokers like TenTrade are financial institutions that makes it possible for you and I to trade in the financial market. All right. Forex brokers are like the middleman. So you as a retail trader, you cannot trade directly in the financial market. You need to go through a Forex broker. All right. So back in the days, before the Forex market got decentralized such a way that anybody cannot trade, the minimum amount of money you need to trade in the financial markets, I think, was about $100,000 or close to $1 million, right? And then you could actually trade over the counter, right? But now, anybody with less than $100 can trade now in the financial markets, leveraging on brokers. So what the broker would do is to give retail traders leverage. Okay, so they give you so your $100, they'll give you leverage. Okay, so don't worry. By tomorrow, we'll talk about practicals. We'll go through what leverage is. Okay, so let's say when you create an account with a Forex broker, you can use a leverage of 1 to 100. So that means for every dollar that you have, the broker is going to match it with $100. So that means your $100 now is actually worth $10,000 in the financial market. So you have higher purchasing power to buy currencies and make trades in the financial market. So because the broker helps you trade in the financial market, they actually control the price at which you enter the market. All right. So that's why they are market players. All right. So brokers can control how much you make and how much you don't make based on, the technology involved. Then you have companies. These are small companies, for example, private equity companies that also trade for people. All right. In hopes of making a profit, similar to hedge funds. Then the people at the bottom of this food chain is individuals, which are people like you and I, okay, with the lowest amount of capital. Okay, an average retail trader is funding with $500. Meanwhile, an average hedge fund is trading with $1 billion. Okay, so the difference is massive. Now, I must tell you that every market participant is trading in the financial market to make money. Just the way you are learning how to trade Forex to make money, hedge funds, central banks are also here to make money. How will they make money? Let me tell you the honest truth. When you make money in the financial market, that profit that you made is because somebody else lost money. So you are making profit because somebody else made a bad trading decision. All right. So, and you must know that in order for you to be very, very profitable in the financial market, you need to know exactly what you are doing. All right. Because you are trading you are trading with people that have solid trading teams. Okay. An average hedge fund has a team of traders that help them make very good trading decisions. They even have very highly sophisticated algorithms or trading systems to help take advantage of some loopholes in the market. So that is why, the statistics out there states that the majority of forex traders lose money. Okay, so when you lose money, that means either the hedge fund, the commercial banks, other people are making money. So to be profitable, to make money in the financial market, you need to settle down and learn and master this skill set. And that's what this 4-day bootcamp is about, to help you make the right trading decisions, right? You can make a lot of money trading in the financial market if you are willing to learn what it takes. All right. So you don't want to be like everybody else that just thinks that trading in the forex market is a get-rich-quick scheme. No, right? If you have that mindset, forex wouldn't work for you. So you want to see forex as a business, see it as a career, and devote a lot of seriousness to it and commitment to it. If you want forex to pay you serious money, then you need to take it seriously. Okay, take it as a business, take it as your career. Okay, just the way. So let's say for example, you are an employee now, right? You go to work 8 a.m., you get back from work 5 p.m. You know that if you don't go to work early enough, you possibly get a query or like they will fire you. Okay, so an average employee takes their work seriously. That's why they can wake up 4 a.m., for example, in Lagos and get back home 11 p.m. Okay, an average employee is very, very serious. So that kind of dedication that you put to your work, your business, I need you to put that kind of dedication as well to the financial market. That is when it will start paying you the kind of money you want it to pay you. Give me some feedback in the chat box, guys. Let me know if you are still with me. Type in a yes in the chat box if you understand what I've said so far. Okay, give me a yes in the chat box if we are on the same page. Let's go, guys. Good. Kelechi, thank you for your response. Who else is with me? Temi Tokpa, yes. Awesome. Who else? Who else? Give me some feedback, guys. Give me some feedback. Give me some feedback. All right. So let's move on because of time. All right. So now, we've talked briefly about forex brokers. That's simply the middleman, right? Makes it possible for you and I to trade in the financial market. So that's what 10Trade is offering, right? So you are here to learn actual forex. You must go through a forex broker to trade in the financial market. So the first broker provides a lot of infrastructure for you to trade in the financial market. They give you leverage, right? We connect you to liquidity providers. We put you into the market at a very, very good price, all right? And then when you make a profit as well, we help you move your money into your account so that you can make a withdrawal. So there is a systematic process that's been put in place to make it very, very efficient, all right? So you also must be very, very wary of dealing with just any broker, right? There are brokers out there that are not licensed, that are not regulated. If you trade with those brokers, you are doing something very, very risky, all right? So 10Trade is highly regulated, right, and licensed. So you want to trade with 10Trade because 10Trade is licensed. So when it says something is licensed and regulated, so that means it is thoroughly audited, okay? So, and that gives transparency into everything that we're doing at 10Trade. So you want to trade with 10Trade for peace of mind. So if you've not created an account with 10Trade, the first thing you want to do is to create a trading account with 10Trade, right? So you want to reach out to the person that invited you to this webinar and then request for the registration link from that person. It is very, very important you do that because that is your gateway to accessing the ecosystem that TenTrade provides. So you want to reach out to that person. Just tell the person you want to register at TenTrade. So the person will give you the link to register. All right. So when you register, you get access to all that TenTrade provides. So today we are going to be doing majorly the theoretical aspect of Forex. So tomorrow is when we go deep into practicals. So your first assignment is to create an account with TenTrade, because by tomorrow we'll be trading, taking trades, taking buy and sell orders, looking at charting platforms. But if you don't do this day one, by tomorrow, you might be a bit lost. Okay, so I want you to be on the same page with us. So please reach out to the person that invited you to this webinar and then create your account with TenTrade. It's very, very easy to do that. Okay, under 2 minutes, you're done. Okay, I would also do a little walkthrough on like how to do that before the end of this session. All right, so let's right now, let me just quickly give you a bit of walkthrough, and then we'll take a break for 2 or 3 minutes for you guys to go through that. So after you've gotten the link to create your account, I'll just skip to the website right now. Please, you want to ask for the link from the person that referred you to this webinar. It's very, very important, because that person would also have a lot of goodies in store for you for using his link. So you want to get the full benefits of creating an account with TenTrade. So I'll just do a bit of walkthrough what you need to do. So once you create your account, once you get the link, right, you'll be taken to the website. As you can see, a very, very beautiful website. You click on register. Once you get to the website, naturally directly to the registration page, like so. So this is what you're going to see when you click on the link given to you. Okay, you want to register as individual client, or if you're a corporate client, okay, so you can do that, whatever applies to you. Put in your title, your first name, your last name, right, your birthday information, and everything you need. So once you are done, all right, you want to click on I confirm, and then you click on continue. All right, so that's all you need to do. Once you do that, you'll be taken to your dashboard. All right, so let me wait for 2 or 3 minutes, just in case we have people on here that are trying to get the link and do that. I would like to go through this process with us together. So this is 6:54 p.m. Nigerian time. By 6:57 latest, we would get, I'll come back, and then we'll go ahead to the next content. All right, so I'll be with you in the next 2 or 3 minutes, guys. All right, guys, we're back. So let's go ahead and move forward with the class. Okay, so let's start going into the meaty aspect of this bootcamp. Let's delve into the major currencies that we have. Now, in all over the world, pretty much every country has their own currencies, right? With the exception of some zones that use the same currencies, right? So that means we have about, a bit over 100 currencies. Right now, I think we have about 200 countries globally. In those 200 countries, there are some countries that use the same currencies. For example, countries in Europe like Italy, Italy, Greece, they use Cyprus, they use the euro. So there are some countries that use, euro as their legal tender. So we have about 100 currencies, and every currency is active in the forex market. So you can trade every currency in the forex market. Or for the perspective of a retail trader, not is profitable. Not every currency will give you consistent and opportunities. So that we're able to narrow down 8 major that is, for example, that is the 8 major currencies are as follows: as euro,
Hello, is anyone here?
All right, welcome back, guys. Apologies for the technical, it's an issue with Nigerian internet. All right, so thank God for a backup internet connection. So let us go back into what we're talking about. So we're talking about eight major. Thank you, Mr. Kelechi and Tim. We're talking about the eight major currencies that are traded in the financial markets. So we have the euro, you have the Great Britain pound sterling, you have the Australian dollar, you have the New Zealand dollar, we have the US dollar, you have the Canadian dollar, we have the Swiss franc, which is the CHF, and then we have the Japanese yen, which is the JPY. So I see you. All right. Now, all of these currencies that we are mentioning here, these are their symbols. So you need to know exactly what the symbols are. You know, allowing the forex market to make it, you know, easy as possible for you guys. Know what we are doing. When you go to the market may be opposite your street or around your area where you buy your tomato or you buy your bread. Okay, that lady selling tomato is a trader. She's a trader, right? And a commodity, what she's trading is tomatoes, right? How does she make money selling tomatoes, right? She buys tomato at a low price and then she sells for you higher. So she puts her markup. That's how she makes profits. She would only make a loss, okay, maybe when she sells lower than she bought. Likewise, you are also going to be a trader, okay? All right, so you are also going to be a trader. The commodity that you are trading is now currencies. And how do you make money trading currencies? You buy when it is low and then you sell when it is high. So you need to know exactly what you are doing as a forex trader. And these basics, know your commodities, right? The euro, GBP, AUD, they are your commodities. These are what you are trading, all right? So you cannot do without them. Okay, so let's move into the concept of currency pairs. Remember, this is a foreign exchange market, Forex, foreign exchange. Okay, so when we talk about exchange, that means two things are involved when we say exchange. So in the Forex market, we do not trade one currency in isolation because there's nothing to trade if you are dealing with just one currency. We trade currencies in pairs. So you are trading one currency against another currency. So it's like you are trading the Naira against the US dollar, right? So we trade currency pairs because trading currency pairs will give us volatility, okay? Will give us a particular price. So it is that price that we use, that we buy, and then we sell, okay? So these eight major currencies that we have, when we do a combination, when we pair each of them against another, we should arrive at about 28 currency pairs, right? We should arrive at about 28 currency pairs. So let me just apologize ahead of time if the Zoom gets disconnected one more time. Please, I want to apologize ahead. Okay, these are things that we cannot. But there's a backup. So I'm actually working with two different internet connections right now. So if one is messing up, I'll quickly switch to another. All right. So if it goes up, just stay on the line. Don't go anywhere. All right. So when we combine each of those currencies, right, we should arrive at 28 currency pairs that you can trade, which is enough for you to trade for the rest of your trading career. There are people that only trade one currency pair, and that's enough. You don't need to trade the all 28 pairs. If you want to look outside these 8 major currencies, you would have access to more pairs that you can trade. But I'll be very, very honest with you, especially when you're just getting started. You don't really need them. All right. So start with these 8 major currencies, and then once you start getting, solid in these skill sets, you can start branching out into other commodities and indices available to trade in the financial market. All right. So let's move forward. So when we say currency pair, so this is an example of a currency pair. So this is a currency pair called Euro USD, EUR USD, Euro USD. Okay. Now, every currency pair, like I said before, they have their own unique price. They have their own unique exchange rates. So price and exchange rates can be used interchangeably. All right, because that's a price where you exchange one currency to another currency. Now, when you look at the anatomy of a currency pair, for example, what we have on this slide, Euro USD. Now, a currency pair can be broken down into the first aspect of a currency pair, which is the EUR, is called the base currency. That's the base currency. And then the second part of the currency pair is called the quote currency. In this case, the US dollar is the quote currency. All right. And then this is the exchange rate, 1.1302. So what this means simply is that 1 euro is equal to $1.1302. Right. So that means to buy 1 euro, you will need $1.1302. So that means the euro is greater than the US dollar in this particular scenario. So let me also try and bring it home for you. So when you are traveling out, so we are all Nigerians here, I think. So let's say you are going to the US next week. You have Naira with you, okay? In the US, you can never ever spend your Naira in the US. They won't even collect it, okay? So that means at the airport, you need to go to the bureau de change. We have lots of them at the airport. They will gladly collect your Naira and then give you US dollar at a particular exchange rate. Okay, so the base currency in that scenario is what you have at hand. All right, so that is your Nigerian Naira, and then the quote currency is what you are collecting, which is your US dollar. Okay, so I think that's an easy way to explain this concept to you. So because buying and selling occurs with the base currency and the quote currency. All right. So for clarity's sake, before I go into the next concept, I like to use about 2 or 3 minutes to really go deep into currency pairs. All right. So I'm going to share a whiteboard now, and then also use our opportunity to give us an assignment for tomorrow. So let us start by writing the 8 major currencies that we have. All right, so we have the EUR, which is the euro. You have the USD, US dollar. You have the GBP, Great Britain pound sterling. You have the Canadian dollar, CAD. You have the AUD, which is Australian dollar. You have the New Zealand dollar, NZD. You have the Japanese yen. which is JPY, and then you have the Swiss franc, which is CHF. These are the 8 major currencies that we have. So when we combine each of them together, what do we get? So let's do a combination of the euro against every other currencies that we have. So when you pair the euro with every other currency, what do you get? So the euro and USD will give you euro USD. The euro and GBP will give you euro GBP. Euro and CAD will give you euro CAD, euro CAD. The euro and AUD will give you euro AUD. Euro and NZD, euro NZD. Euro and JPY, euro JPY. Euro and CHF will give you euro CHF. Okay, so this is the pair for euro based on 8 major currencies. When you do the same thing for USD, okay, let's just do it. So once you do everything, you arrive at about 28 pairs. So let me do for USD, and then you do the rest yourself as assignments against tomorrow. So USD against the euro, we've done that. Euro USD. USD and GBP will give you GBP USD. USD against CAD will give you USD CAD. USD and AUD will give you AUD USD. USD and NZD will give you NZD USD. USD and JPY will give you USD JPY. USD and CHF will give you USD CHF. Okay, so once you do for GBP, you get something else. Once you do for a card, you get something else. So once you do all of this, you arrive at about 28 currency pairs that you can trade. So guys, your second assignment for tomorrow is you want to do all of the other pairs by yourself, right? You should arrive at 28 currency pairs that you can trade. Now, guys, it's very, very important that you do this assignments because it will make you familiar with your commodity, with what you are trading. Okay, it's like saying a tomato seller does not know all the different what's it called, the different species of tomato and pepper, okay, that are available to trade. All right, so you as a forex trader, you should know the currency pairs are available to you to trade as well. All right, so I recommend that you do the assignment. Okay, it will really help you a great deal. So I'm going to ask everybody tomorrow if they did the assignment. Okay, and then you possibly get a gift for doing the assignment. Okay, so assignment number 1 is to create an account with 10 trade. Okay, number 2 assignment is to on your own jotter. I believe that we are all writing down something. You have where you are jotting down these lessons. You want to write out all of the currency pairs that you can get from these 8 major currencies by pairing one currency against another. Okay, so that's your second assignment. All right, so let's go back into the slide real quick. All right, so we should be out of here in about the next 30 minutes. I don't want to take too much of our time. All right, so buying and selling currency pairs. This is the only thing that you are going to be doing. This is what you'll be doing to make money. You are buying and selling. Just like the way the tomato seller will buy and sell tomato, you as a forex trader, you are buying and selling currencies. This is what you'll be doing to make money. All right, so the skill set that you need to learn is to know the best. A woman selling tomato wouldn't just buy from any supplier. Okay, of course, they will know the best price to buy. so that when they sell, they can make a profit easily. Likewise, in the forex market, when you are buying, you want to buy at a very, very low price. You want to buy at a discounted price. Okay, so that's a skill set that you need to learn to make money. And then when you want to sell at a premium price. That's how you make money. Okay, so that's a skill set that you need to learn. And then by day 3 or day 4, we'll go deep into the concept of buying and selling, how to know the best zones and the best prices to buy. Okay, so let's talk about the concept of a PIP. So what is a PIP? So we are gradually moving into practicals. To explain what a PIP is, after I'm done with this slide, I'm going to take us to measure PIP, right? So what is a PIP? A PIP is a unit of measurement used to show changes in the rate of a pair. It tells us how far price has moved within a particular period of time. Take it again for a unit of measurement All right, guys, so we're back. Now, we're talking about the concept of a PIP. So how do you make money in a forex market? You make money based on the volatility, right? So let me give you an example to tie this in, okay? When you move from, so most of us are maybe going to our place of work tomorrow. So from your apartment to your place of work, you are going to travel. You are going to move. Okay, so that is distance. So you have moved from your apartment to your office. Now that distance is measured in meters, right? The smallest unit of measurement of distance is meters, right? So that's how we measure how far you traveled within a particular period of time. Likewise, in the forex market, like we said, price is volatile. There's volatility, there's fluctuation. When price moves from one point to another price, okay, we measure that movement by what we call pips. Okay, so that's why we say a pip is a unit of measurement used to show changes in the rate of a pair. Okay, it tells us how far price has moved within a particular period of time. So let's do 2 examples to explain this properly. So Given this currency pair, we have Euro USD. And as you can see, price moved from 1.1005 to 1.1006. So how do you calculate pips? There are two major ways to calculate pips. You have the manual way of doing it by calculating it manually. And then we have the automatic way of doing it by leveraging on trading platforms and using some tools to calculate pips. All right. So, but an average trader would naturally gravitate towards using the tools, doing it automatically. But I have not seen an expert trader that doesn't know how to calculate pips manually. So that's why I always like to explain to you, how do you do it off the top of your head, so that even though you don't have access to those tools, you can do it easily. So the easiest way that you can calculate pips manually is to simply, so when you're trying to calculate how far price has moved, the first thing you want to do is to, number one, subtract the starting price from the end price. So the price that you're trying to calculate from. So right now, we're told that price moved from 1.1005 to 1.1006. Easily just subtract. You can subtract. If you're a good math student, you can do this offhand. Okay, easy math. Or you just bring out your calculator on your phone and then calculate and then get it. So when you subtract, what will you get? You will get 0. Okay, 0, 0, 0, 1. Okay, that is the subtraction between this number and this number. That is step one. Check, you subtract. Okay, and then step two, to calculate, to get the exact p value, is to move this decimal number. Now, there's a caveat emptor to moving this decimal. So, two things that you must note. Just two conditions, right? For every currency pair, aside from JPY pairs, okay, for every currency apart from JPY, you move this decimal 4 places forward. 4 places forward. Okay, 4 places forward. Okay, and the second condition is that for JPY pairs, so any pair that you see that has JPY, you move it 2 decimal places forward. But for every currency pair that does not have JPY in it, you move this decimal 4 places forward. All right. So in this case now, that when we subtracted step one, step two is, because we know that there's no JPY here, so what we should do is to move the decimal 4 places forward. So simply just move it 1, 2, 3, 4. So when you do that, this will give you 1.0. Okay, so that's how we're able to arrive at 1 pip. So 1.0 pip is the value of this volatility here. So when price moves from 1.005 to 1.1006, right, the value in pips of that movement is just 1 pip, right? And then we're able to calculate that manually. This took us less than 2 minutes, okay? Once you get very, very solid with this calculation manually, under a minute or a few seconds, you will know exactly how to do this easily. Okay, for this USD JPY pair, okay, step one is to subtract. So subtract 104.20 to 104.21. So when you subtract, you get 0, oops, you get, wait, hold on, let me do this again. You get 0. So there's something wrong with my, it's not right. Okay, good. You get 0.01. That is when you subtract. Okay. So when you subtract this, okay, I think I want now to go to, perfect. So step 2 is to, because we know that this is a JPY pair, we'll move it 2 decimal places forward. So we'll move the decimal 2 places forward. So easily move this 1, 2. So you get 1.0 pip, right? That's how we're able to arrive at the pip value there, okay? 1.0 pip. So that's how you calculate pips manually, okay? So let me quickly take you to how to calculate this automatically. Tomorrow we are going to do a real walkthrough of this platform. Now there's a platform that is called MetaTrader. Okay, so MetaTrader is a trading platform that gives us a visual representation of the fluctuations in market price. It gives you a visual representation of the volatility in price. Okay, so on that particular platform is also where we do our analysis, is where we buy and sell. So on this platform, there is a tool that can easily help you calculate pips. So I'll just jump and then show us that real quick. But tomorrow we would delve into the concept. So just pardon me while I show the platform in a nutshell. So before we end this class, I would also show you how to download this platform on your mobile phones and on your laptop as well. So this is the MT5 platform in a nutshell. This is how it looks like. Again, tomorrow we'll go through this platform properly. Let me just show you how you can calculate pips easily. So let's say you are trying to calculate how far price has moved. So price moved from, let's say, these high points now to these low points. So maybe this happened today or in a few days. So you want to know how far price has moved from here to here, right? So which tool are you going to use? So let me zoom in on this. All right. So price moved from this zone to this zone. Okay. And then check out all of the prices here. So this is the price, as you can see, it highlighted in white. Let me do that real quick. In white. So the tool that you use when you are using the MT5 platform is called the crosshair tool. Let me write it down for us. It's called the crosshair. Okay, it's called the crosshair tool. And where do you get the crosshair? Right, this is it right here. On the menu at the very top, you see this cross sign here. That is a crosshair. So that is a tool that you want to select. All right. So just go over there and select the tool. When you select it, you start seeing this cross thing on the chart. So what you do is to simply select from the beginning of where you want to start from to the end. So just drag it from the beginning. So let's say it's a price, click on it, and then you drag it all the way down to where you want to end. Once you do that, you will see some values showing by the side. You can see something. So the value of the crosshair is in points, not pips. Again, the value that you get when you use a crosshair is in points, not pips. So over here, we can see that price has moved 3862 points. 3862 points. So let me write that down. So price has moved from here to here. All right. 3862 points. All right. So how do you convert points to pips? Right? You just simply divide it by 10. That's all. Okay. So divide it by 10. So 3862 divided by 10 is what? 386.2. Right? So that is 386.2 pips. So that is how you calculate it in a nutshell. Let me know if you understand this concept real quick. And give me some yes or no in the chat box if you know how to calculate pips now. Put a yes if you understand what I've said so far, and put a no in the chat box if you don't understand. Temitope said no. Thank you for your honesty. Who else doesn't understand? Kelechi said no. Okay. Ade said no. All right, good. So also let me ask further, which one don't you understand? Do you understand when I was talking about how to calculate it manually? Do you understand how to do it manually? If you can do it manually, if you understand the manual process, type in yes or no. Okay, so this second one is the one that is not clear. All right, good. So let me go over this again then. Okay, so let me go to another and do this. So taking it again, let's say we want to measure how far price has moved from this low point here. From this low point to this high point. So price has traveled from here to here. All right. So I want to measure how far price has moved from this low point to this high point. The tool that will help you measure pips is called the crosshair tool. Okay. It's called the crosshair tool. And where can you get the crosshair tool on MT5 platform? You see it at the very top here. You see the cross icon, the symbol here. All you have to do is just select it. Once you select it, you see the cross thing is gonna start displaying. So from the starting point where you want to measure from, okay, so just click on it and then you drag all the way up. Okay, once you drag all the way up, you see some figures to your right. All right, you are concerned about the figure that talks about the point. So that measurement is in points. Looking at this, we're told that this is 3089 points. 3089 points. That is 3089 points. That's a movement. So, like I said, the crosshair does not give you the pip value. It gives you the value in points. So when you get the value in points, you just simply divide it by 10. That's all. So the value in points is in 3089, is 3089. So let's write that down. So this is 3089 points, 3089 points. All right. So to convert these points now to pips, you simply divide this value, this 3089, divided by 10. Okay, so 3089 divided by 10 is what? 308.9 pips. So that's a conversion to pips. So you just put a decimal at the last number there. Is it clear now? Let me know if it's clear now. Give me some yes or no in the chat box. Give me some yes or no in the chat box, you can understand. Okay. It's clear now. All right. It said, is it the same? Yes, it is same, but with the mobile phone, you are not able to use the crosshair, unfortunately. There's a crosshair. There's something like a cross on the mobile, but you cannot you cannot measure. All right, so the measure tool is only available on the PC version. So that's why it's good to know how to do it manually when you want to. Okay. All right, so let's move forward so that we can round up this session on time. So let's go back to the slide. Everything's going to make sense to us in a nutshell. We will know exactly why we are calculating pips and how it's going to turn to something monetary for us. So when we tie everything into the next concept, which is lot size, that'll give us a better understanding. But before we do that, let's talk about the concept of spreads. All right, so I won't dwell too much on spreads, but it's good that you understand what a spread is, right? So what is a spread? A spread is the difference between the bid and ask price. So in a nutshell, the bid and ask price is a price in which the Forex broker is going to quote you into the market for a buy or a sell. So this is a bid price, and then this is the ask price. So if you want to sell a particular currency pair on a particular broker, for example, on TenTrade, if this is the bid and ask price, if you are selling a particular currency pair, this is the price at which you are going to be entered into the market for that sell, which is the bid price. If you want to buy any particular currency pair, it is the ask price that will be used to give you that quote into the market. All right, and that quote is there's a little bit of difference between it and the actual exchange price. Okay, so this bid and ask price is not the actual exchange price. Okay, in a nutshell, don't let me confuse us. Spread is simply what the broker will charge you to enter for every trade that you place into the market. All right, so if you are placing a buy or a sell trade now, the broker is going to charge you for spread. All right, and then the broker has every right to charge you for spread, because in order to help you place a trade in the financial market, they are providing you leverage. Okay, they're providing you with the infrastructure and everything that you need to get your money in and out when you make a profit. All right. So spread is a difference between the bid and ask price. So the difference between this sell and this buy. Okay, when you subtract this, all right, the spread is 1.5. So you want to deal with a broker that has low spread. All right, with 10 trade gives you a low spread. So when you want to enter into the market now, right, you'll be charged 1.5 pips as per this example here. All right, so this is the broker's commission. This is how a broker would, this is the business angle of a broker. Okay, so like I said, I don't want to go too deep into spreads, okay, because spreads is a topic on its own. There are fixed spreads, there are variable spreads, you know, but all of that, you can get to know them once you have a solid understanding of the market, okay? But know that for each trade that you are placing in the financial markets, you are charged a commission or you are charged a spread. All right. And 10 trade gives you a very, very tight and little spread to trade in the financial market. All right. So I'll just keep that and then go into the next topic. Let's talk about lot sizes real quick. Okay. So a lot is a number of units of base currency that you can buy at a particular time. Okay, so the easiest way that I like to explain lot size is to liken it to a sport betting platform. You know, most of us that are on social media that watch our Nigerian skit makers, you'd always hear them talk about a company called 1xBet. Okay, so 1xBet is a betting platform. For example, the last World Cup, Argentina versus France, there are a lot of people that like to put their money where their mouth is. So those that are supporting France would, you know, bet that France will win. Those that are supporting Argentina will bet that Argentina will win. Okay, so let's say I want to bet that France will win. I'm so convinced and I'm willing to put down 10,000 naira of my money to trade to, you know, bet that France will win. Okay, that 10,000 naira is my stake. Okay, so that's how much that bet is worth for me. So if I lose, I lose, you know, that one. That is my stake. All right. So likewise, in the forex markets, when you enter a trade, you'll be required for, okay, how much are you willing to put into this particular trade? How much of that currency are you buying or selling? Okay, so lot size is what helps you determine your stake. And that's what will determine how much you would win or lose trading in the financial market. All right. So looking at this table, I want you to focus, you know, don't focus on this unit. Okay. Let us skip this for now. Focus on this column, lot size, volume, and the dollar per pip. All right. Now we have 4 major categories of lot size. The lowest being the nano lots. Okay, then you have the micro lots, we have the mini lots, and then we have the standard lots. All right. So let me make this a bit clearer. I'm going to go to the whiteboard and explain this to us. Okay. It's easier when I explain it that way. So let's do it. So we have 4 major categories of lot size. We have the nano lots, you have the micro lots, you have the mini lots, and then we have the standard lots. But unfortunately, right now, the nano lots is not, on most brokers, is not available to be used. All right, so a broker would only give you access to trade micro, mini, and standard lots. So let us take away nano lot, because you will not be required to use nano lots to place a trade in the market. Okay, but just know that it is the lowest form of lot size available. So there are the units here, or the volume for micro lots is anything between 0.01 to 0.09. If you use anything of that in that sequence, that's a micro lot. A mini lot starts from 0.10 to 0.99, right? While a standard lot starts from 1 to infinity. So based on broker, I think 10 trade will give you up to either 500 or 1000. Okay, so let's now talk about what does it mean to use 0.01 or any of these numbers here. Okay, what does it mean? So let's start from micro lot. Okay, so when I use a micro lot of 0.01 to enter a trade, how do I convert that to a dollar value? What does 0.01 mean? Okay, so I'll do a few examples to make it clear to us. So if you use 0.01, the easiest way to convert it to a monetary value, so I'll just use a general example. You simply multiply 0.01 times 10, and then guys, you wouldn't need to do this calculation yourself. All right, the broker will do it for you automatically, so you know exactly how much you are losing or making in real time. But it makes sense to know beforehand what this whole thing means. So that's why I'm explaining it to you. So if you use 0.01, just simply multiply by 10. When you multiply by 10, you get a dollar value. So by 10, you get 10 cents. So 0.01 lot size, it means that this is 10 cents per pip. So that will give you the pip value. So that means every little move in the market is worth 10 cents to you. All right, let's do another example. If you use a lot size of 0.03, it's still a micro lot. What does it mean for you? Multiply it by 10. Okay, it means that every pip in the market is worth 30 cents to it. So that is 30 cents per pip. That's your stake in that particular trade. So every move is every pip is worth 30 cents for you if you use lot size of 0.03, okay, which is a micro lot. So if you use a mini lot, which start from 0.10, so let's start from the basic of mini lots. 0.10, how much is that worth to you? You multiply it by 10 to get the dollar value per pip. So 0.10 times 10 is $1, right? So that's $1 per pip. So that means every pip in the market is worth $1 for you. Okay, if you use a mini lot of, let's say, 0.55, it's still a mini lot because it's still under, see, it's still less than 0.99, right? 0.55 is less than 0.99, so that's a mini lot. Multiply by 10, what do you get? 0.55 times 10 is 5.5. So that is $5.50 per pip. So every pip in the market is worth $5.50. Let's use a standard lot. For a standard lot, what does it mean? So let's use standard lot of 1.0, which is a minimum standard lot. What does that mean? You multiply by 10. All right, and what do you get? 1 times 10 is 10, right? So that would be $10 per pip. That means every pip is worth $10. Every little, the smallest move in the market is worth $10 if you use a standard lot of 1.0. If you use a lot size of, so remember, 1 to like 500 or 1,000 is a standard lot. So let's use a standard lot of, let's say, 75, 75.5, for example. You multiply it by 10. What does that amount to? Okay, so that's equal to $755 per pip. That means every pip in the market is worth this much for you, right? On the 4th day, which is the last day, we are going to be talking about risk management. So under risk management, one thing that we'll talk about is knowing the right lot size that you should use based on your account size and trading parameters. All right. So somebody trading with a lot size with an account capital of $100 will use a different lot size than somebody trading $1,000 or someone trading $10,000 or someone trading $50. So your account capital will greatly determine the lot size that you'll be using, also based on your style of trading. If you are an aggressive trader or you are conservative, you use different lot sizes. So on Thursday, we'll do a deep dive into figuring out the best lot size that you should be using per trade. So let's go a step deeper. So if you use a lot size of 0.01, that means that every pip is worth 10 cents to you. So let's say you enter a trade, and then in that particular trade, you make a profit of 10 pips. 10 pips profit is equal to, so if you make a 10 pips profit and each pip is worth 10 cents, that means 10 pips profit would amount to 10 times the value per pip, which is 10 cents. So 10 times 0.10. So that means in that particular trade, you would make 10 times 0.1 is what? $1. You make $1 profit, right? If that trade goes against you, you would have also lost $1. Okay. If you took this trade, you use a lot size of 0.03, and then you made 10 pips profit. What does that amount to? 10 pips profit in this case would be 10 times 0.30, okay, which is equal to what? $3 profit. If you made a loss, if price went against you by 10 pips, that means you made a loss of 10 pips. So that means you would also lose $3. So it goes both ways. It goes both ways. If you graduate into using a mini lot, which is a higher stake in the market per pip, so if you use a lot size of 0.1, which means $1 per pip, and then you make a profit of 10 pips, for example, 10 pips profit. What does that amount to? That is the 10 times the value per pip. The value per pip is what? $1. So that is 10 times 1, which will give you $10 profit. If you made on that trade, you lost 10 pips, you would have lost $10 as well. Hope I'm communicating, guys. Give me some feedback if you understand this concept so far. Type in a yes if you understand, and type in a no if you do not understand or need more clarification. Let me know if I'm carrying you along, guys. Give me a yes if you understand, and then give me a no if you don't understand. Circulation understands, perfect. Who else understands or doesn't understand? Temitoko understands, perfect. So good. So I think you have 2 responses. Let me know if you don't understand. I'll go over it again for your sake. Don't be shy. We are here to learn. If you don't understand, please speak up. It's very, very important that you do so that we can be on the same page. Okay. Ade understands. Perfect. Good. So if you use a lot size of 0.55 and then you are in 10 pips profit. So 10 pips profit on 0.55 lot size is equal to 10 times the value per pip, which is $5.5. Okay. So that'll give you 5.5 times 10 is 55. That's $55 profit. If you lost that trade, you would have also lost $55. Okay. When you graduate to standard lot, trading is standard lots is where you want to be as a trader. So that's when you start making the big bucks in the realms of thousands and tens of thousands. All right. But you have to start from where you can start from. But eventually try and get to trading a standard lot. Right. So for a standard lot of 1.0, what does it mean? Okay, if you make 10 pips profit, right, that will be 10 times the value of each pip, which is 10. So 10 times 10. So that trade, you'd have made a profit of $100 just like that. And I must tell you that it is very easy for price to move 10 pips. Okay, very, very easy. If you are trading in the right direction. If you lost that trade, you would have also lost $100. If you made profit, you would have made $100 profit. Okay. If you use a high lot size like this, 75 lots, and then you made 10 pips, you made 10 pips profits, that would be 10 times, for a lot size of 75.5, the value per pip is $755. So 10 times 755. Okay, so that will have given you what? $7,550 profit. Okay, if that trade goes against you, you would have also lost that much. Okay, so we can enter the same trade at the same price and exit at the same price and come out with different profits or loss. What will determine what would determine the difference between how much we make is the lot size that we use. So I can use a micro lot size and you use a mini lot size, and then we enter the same trade. We place entry at the same price. We exit at the same price, but how much you make and how much I make will be different. That difference is because we used a different lot size. Okay, you can see how we've been able to bring lot size and pip together to understand how we make money in the market. All right, so lot sizes and pips work hand in hand. Okay, so guys, I recommend, if you're a beginner, before our next class tomorrow, if this particular concept is still a bit fuzzy for you, which is understandable, I recommend that the replay of this class will be made available on the YouTube channel tomorrow morning before 12 p.m. It should be on the YouTube channel. So please, you want to watch the replay before our next class so that once we are doing some practicals tomorrow, you can follow along easily. Okay, so let's move to the next concept real quick. So I'm gonna go to the PowerPoint slide. I want us to be done in the next 10 minutes. We've been here for about 2 hours now. All right, so let's talk about Forex trading sessions in a nutshell. Let me see. All right, good. So we have just 2 slides remaining. So on that 10 minutes, we can be done. Okay, so Forex trading sessions. Remember, we said the Forex market is open Mondays through Fridays, and we do not trade in the Forex markets during the weekends. All right. So simply, Forex trading sessions. Remember, my recommendation is that you focus only on the 8 major currencies, which is the euro, the dollar, the Australian dollar, the pounds, the Canadian dollars. Now, every currency has its own session, and session talks about when a particular currency is active or when activity starts, the time at which activity starts on a particular currency. Okay, Kelechi said, but the candles move during the weekends. No, candles don't move during the weekends. You would only see a candle move maybe on a cryptocurrency pair. Okay, in the crypto market, there's activity during the weekends. Price, because it's crypto, it's not a currency, it's not a business, right? Like that. So candles, the market is open all day in the cryptocurrency market. But in the currency market, okay, activity during the weekend is not recorded. So market closes on Friday. All right, don't worry. Kelechi, by tomorrow's session, we'll go through all of that. So you see it in real time, what's going on. Okay. So as I was saying, sessions simply tells us when the time in which a currency is mostly active. So when activity starts on a particular currency and when it ends. And for the purpose of the 8 major currencies that we are advising that we focus on, we can categorize them into 4 sessions. Okay, every currency has its own session. For example, there's also a Nigerian trading session. Assuming the Naira is a major currency pair, we would have like the Nigerian session or the Lagos session. But we are focusing on just the 8 major currencies. And we have just 4 sessions that we want to deal with. We have the Sydney session, we have the Tokyo session, we have the London and the New York session. So Sydney session, Sydney is in Australia. Which currencies are in Australia? We have the AUD. We have the AUD, right? And then we have the NZD, New Zealand dollar. Okay, because we say that this is a session because this is when AUD and NZD, when they are most active, because that's when business starts in Sydney. So 8 a.m. in Sydney. So you just convert it to your own time frame. So if you are in Lagos, Nigeria, for example, 8 a.m. in Sydney is going to be about 10 p.m. your time. All right, so this is my own time. That's why it's Cyprus. I have to update this, by the way, because I'm in Nigeria currently. All right, so Sydney is the first Forex trading session. And the time, you just convert it to your own time frame. So which is 10 p.m. Nigerian time. So Monday, 8 a.m. Monday, Sydney time is going to be Sunday night, 10 p.m. Sunday night, Nigerian time. All right, so that's why the Sydney session, when you are in Nigeria by Sunday night, if you are interested in trading in the Sydney session, you can start trading Sunday nights as from 10 p.m. or 11 p.m. based on their time zones when they have daylight savings and things like that. All right, Tokyo session is for the Asian, Japanese yen. You have the JPY. That's when JPY activity starts. That's when business starts in Japan, in Tokyo. So the Japanese yen will kick into effect from the Tokyo session. So there will be a lot of activity during the Tokyo session for JPY. Okay, and then this is the time zone conversion to my own time. In Nigeria, 8 a.m. Tokyo time is around 1 a.m. So you most likely be asleep when this session is active. For London is when you have the Great Britain pounds. That's when it's active. You have the Euro is also active in this session, EUR. And then we also have the Swiss franc is also active in this session, CHF. All right. So, and then this is around 8 a.m. Nigeria. So 8 a.m. London time is around 8 a.m. Nigerian time as well. So that's when these currencies are mostly active because that's when business starts in London. Okay, so that means the banks are now open in London. They've started doing transactions, moving money here and there. So you see a lot of volatility in these pairs based on their sessions. All right, and then for New York, this is the US dollar. This is New York dollar and the Canadian dollar. So these are currencies in North America, right? The Canadian dollar, USD, and then CAD. Okay, so 8 a.m. based on the US time is going to be around 1 p.m. Nigerian time. So you can trade from those periods. So my recommendation for you, because the currencies in the London and New York are very, very strong currencies like the US dollar, euro, pounds. And then luckily for us as Nigerians, these are times where we are awake, times where you are not sleeping most of the time. So it is recommended that you trade in the London and New York session. And also there tends to be more volatility during the London and the New York session. So from 8 a.m. Nigerian time to 10 p.m. Nigerian time, Mondays through Friday, is an ideal time to be looking for profitable trading opportunities in the markets because there tends to be more volatility in the London and New York session. When there's volatility in the markets, that means there will be an opportunity to trade in the market. So except as you grow your knowledge of the markets, you start to develop some affinity for the Sydney session or some other currencies, you start trading in some specific sessions. So there are some people that only trades the Tokyo session. So they've created a system that works during that session. So they only trade Tokyo. All right, but if you're a beginner, you're just starting out, my recommendation, you want to trade during the London and the New York session. because that's where you see more trading opportunities. All right, so let's go to the last slide of the day. We want to talk about candlesticks anatomy. Okay, candlesticks anatomy. Remember what we said about volatility, about fluctuations of price. When price is moving from one point to another, the representation in the forex market, we represent it with candlesticks. So when price moves from one point to another, the visual representation is by candlesticks. So that's how we know that price has moved from one point to another. So when you see a candlestick, what is the interpretation of a candlestick? So let me quickly show you what I'm talking about real quick. I showed you when I went to MT5. So this is MT5. You will see the green and red candles. Okay, it looks very, very abstract. It does not really make sense. All right, but this is your market. Okay, this is what you'll be studying to make money in the market. All right, so every of these candlestick has to make sense to you in order for you to make a trading decision. So we want to start from the very basics. Okay, looking at the anatomy of candlestick. What does it entail? What story is each of these candlestick telling us? Once you understand the story that it is telling you collectively, then that will give you a different story. But let's start from the very basics, okay? That's what that slide is all about, candlestick anatomy, okay? So we have two major candlesticks, just two. We have the bullish candle, and then we have the bearish candle. The bullish candle is a candlestick that gives us a representation that a currency pair has increased in price. So that means the exchange rate has increased based on a particular time frame. So when you see a bullish candle, that means there is strength has come into the market at that particular time zone, that time frame. The next candle is a bearish candle. So bearish candle signifies weakness. That means that particular currency pair, the exchange rate has gone down. So that is what red means. And the good thing about this MT5 platform is that we can actually view what price is doing based on different time frames. So if I want to know how price is moving every hour, okay, I can select the hourly time frame. So right now, price is on the 1 hour time frame here. So that means every candlestick here represents 1 hour. That means it took 1 hour for each candlestick to form. All right, so we have a market representation here that's giving us the volatility of price every hour. Okay, if I want to view the market, know how price is doing on a daily basis, I'll just change the time frame from 1 hour that it is to daily. Daily is D1. So by daily, I'll see another representation here. It will give me a different perspective here. So on the daily chart, each candlestick represents 1 day. That means this small green candle, it took 1 day for it to form. This big red candle, it took 1 day for that move to happen. So based on what you're looking for in the markets, you can check out how price is doing every week or every month or every 1 minute. So it depends on what you want to do as a trader. Okay, so we have 1 minute time frame, you have 5 minutes time frame, you have 15 minutes, you have 30 minutes, you have 4 hours. Okay, don't worry. Tomorrow we would, go into this platform properly, and then I'll show you some things. Okay, so I just had to say that to help you put this into context. So back to the anatomy: bullish candle and bearish candle. So this is how a standard bullish candle will look like. So what is going on here? So when you see this bullish candle, so in any particular time frame, you see this. So what it means is that over here, so let's say this is the 1 hour time frame. So 1 hour time frame. That means it took 1 hour for this green candle to form. All right. So and right now, let's say this is 8 p.m. 8 p.m. Nigerian time. So this is the open price. That means at 8 p.m. Nigerian time, it is at this price, okay, that we saw the open of this candle. So we have the open price here at 8 p.m. This is the price. This is where price was at 8 p.m., which is the open price. Okay, when price opened here, because bullish candle signifies strength, that means there's an increment in price in exchange rate. So price moved from a low point to a high point. That's the bullish candle. So price opened here. When it opened here, it went up, started going up. Okay, and then it closed over here at this price. So it will close here at 9 p.m. Remember, it's a 1 hour candle. 9 p.m. So at 9 p.m., this is the close price here. So this is the price at which price closed at 9 p.m. So which leaves us with high price and low price. So let me give you a perspective. So when price opened here at 8 p.m., before it started going up, all right, it first of all came down. Okay, it came down into this place. Okay, but it came down briefly here. It did not stay down. But because candlesticks gives us a visual representation of price, it's going to record all the movements that was made in the market within that time frame. So at a point in time, price came down here, but it did not stay down. This is the lowest that price came before it started going back up. So we call this the low price. It's the lowest price that price got to within that 1 hour time frame. So that's the low price, lowest price. And then price was going up. Let me bring back my marker here. So price kept going up. Okay. Price came as high as this zone. Okay, but it did not stay up. But that movement up had to be recorded, that at the point in time, price came to this price. The exchange rate came to this price here. So this is the highest that price came in that time frame within that 1 hour. So price came as high as this, but it did not stay up, but that move had to be recorded. Okay, then eventually price started going down, okay, and closed at this price. So when you see a candlestick, it gives you a visual representation of volatility, of movement. So it lets you know how price moved within that particular time frame. So different time frame would have their own different moves, how the candlestick will be represented. I hope that makes sense, guys. Let me know if it makes sense. Type in a yes in the chat box if you understand that concept. If you don't understand, please type in no in the chat box. Let me know if we are together. Okay. Much sense. Yes. Perfect. So let's do the next candle and then we'll wrap up our session for tonight. So let me clear this. So this is called the wick, okay, W-I-C-K, and then this is called the body of the candle. So a candlestick is made up of the open price, close price, high price, and low price. This is the wick, and this is the body of the candle, as you can see here, okay? For a bearish candle, because a bearish candle represents weakness, so that means price moved from a high point and then it went all the way down. So for a bearish candle, this is the high, this is the open price. Price will open at the very top. Hold on. So price will open at the very top here. So this is the open price. When it opened here, it went down like so. Okay. This is a close price and it closed. Hold on, guys. All right, so this is a close price over here. And when price opened here, before it started going down to close, it first of all went up. Okay, so this is the highest price. This is the highest that price came to, but it did not stay up. Okay, price went all the way down. It came as high, as low as this low. Okay, this is the lowest that price came in that time frame, but it did not stay at these low points. It reversed up and then it closed here. So when you look at these candlesticks, it lets you know the movement. Okay, it gives you an understanding. So with time, it will start making a lot more sense to you when we start looking at an array of different candlesticks and interpretation, what it means, if you should take entry or not. Okay, so that is bullish candle and bearish candle in a nutshell. By default, the color is not green for bullish, and then the color is not red for bearish. You can change the color to any color that you like, but I just like the idea of green and red. Okay, so that's why on my own chart, you see my bullish candle with green, you see bearish and red. So you can change it to whatever resonates with you. For some people, their bullish candle is blue, and then their bearish candle is white or black. Some even use yellow. So it depends on your kind of person. So on your charting platform, on your trading platform, you can change the color of your candles to any color of your choice. So we'll go over all of that tomorrow. Okay, are we together, guys? All right. So the next thing that I want to start doing by tomorrow is to go over practicals. So tomorrow we'll dive deep into trading platforms. So we'll look at the MetaTrader 5 platform and possibly TradingView platform tomorrow. So here's what I want us to do in a nutshell. I would like you to have downloaded MT5 on your phones and on your computer as well. All right, so that by tomorrow, hold on, I think I've stopped sharing. Give me a second, let me fix this. All right, so that by tomorrow, when I'm dealing with MT5 platform, you would also have your own opened. All right, so again, I want to recommend that you what's it called? Download. So once you are logged in to your your 10 trade dashboard, where is it? Okay, good. So everybody that has an account with 10 trade would have access to their own individual dashboard. So your dashboard will look like this. It will give you access to all of the tools, resources, platforms on 10 trade. So when you log into your 10 trade dashboard, on the left hand side, you will see hold on. You see yes, you see downloads here. You see downloads. So click on downloads. When you click on downloads, you'll be taken to this page. Okay, so this download link, you can use it to download MT5 on your PC, this on your phone, your iOS devices, this on your Android. So I want you to do this tonight. Before you sleep tonight, download it on your, if you're using a phone, do that on your phone and do that on your laptop as well. And then you want to create a demo account. A demo account is a practice account that gives you a simulation of a real market, but it is a demo. It's not real market. It's not a real market. So I want you to create a demo account and then log into your demo account on your MT5 platform before tomorrow. So how do you create a demo account? On your 10 trade dashboard, you want to click on this account tab right here. When you click on account tab, you see open demo account. So click on that, or at the very top here, you see open demo account. It's as simple as, it's very, very clear. So click on open demo account. So when you click on that, under a type, select demo MT5. Okay, leverage, use 1 to 100. Okay, initial balance, you can select anyone, something close to what you'll be funding your live accounts with. Okay, if you're going to fund with 5K, select 5K, and then you click on continue. So when you click on continue, okay, good. Click on continue, and then you can see you have your login details here. So this login details is what you now use to log in to your MT5. So on your MT5, you'll be asked to put in these details. So just copy and paste, and a copy of these details would also be sent immediately to your email, your 10 trade email. So you can get it at any point, at any time there. So create a demo account and log in to your MT5 in preparation for tomorrow's class. Okay, so try and do that tonight before you go to bed so that tomorrow you are set. And remember to do your assignments. I'll do a recap. Your first assignment is to create an account with 10 trade. Your second assignment is to write out all of the currency pairs that you get from the 8 major currencies, right? Your third assignment is to download the MT5 platform on your phone or on your PC. Fourth assignment is to log in with your MT5 details. So once you do all of that, that will help you get ready for tomorrow's session. So tomorrow we'll start practicals proper and start looking at, we'll take a trip together tomorrow. Any questions, guys, before we call it a night? Any questions about what we've learned so far? Okay, if you have a question, you can type your questions in the chat box or signify, and then I'm going to unmute you so that you can ask your questions. So I'll just wait around for the next few seconds to 1 minute max. Any questions, guys? I would like to clarify for you if you have any questions so far. Okay, so while we're waiting for questions, if you have gotten value so far in this session, type in value in the chat box. If you've learned one thing or two that makes sense to you as a beginner, type in value in the chat box. Let me know if this has been very, very good for us. And likewise, also remember to invite people for tomorrow's session. Okay. Temitope said value. Perfect. So that means somebody that you know can also benefit from this training. So tomorrow, ensure that you don't come alone. Invite people in your network, share the flyer on your social media platforms so that you can have more people engage with us tomorrow. All right, so I want to thank everybody for coming, for attending this session, this webinar. Thank you for your time and staying to the end. We've been here for over 2 hours. That means you appreciate what we are doing. I want to recognize your commitment and your desire to learn. Okay, so tomorrow we are going to be here again, 6 p.m. Nigerian time, to continue what we've started. Ade Oluyinka, thank you. Temitope, Kelechi Rufai, so Victor, thank you for being here live. All right, let's have a remarkable night. I'll see us tomorrow to continue the session. Good night, everybody. Bye-bye.